Okay, does divergence work on all time frames? Yes, absolutely. Divergence trading works on all time frames. Remember, we talked about earlier with pattern trading, the market is fractal in nature, which means the same patterns we see on the smaller time frames, we also see on the higher time frames. Okay, so no matter what kind of trader you are, divergence trading will work for you. If you're trading 5-minute intraday charts, if you're trading hourly or 4-hour, more of a medium term setting, or if you're trading daily and weekly and position trading charts, divergence trading will work for you. Okay, let's take a look at some examples on the price charts. Here's a 1-week chart, okay, a weekly chart. So if you're looking at positions, this is what you want to do. All right, we have price moving higher, MACD cycling lower. Here's our low point between the points that diverged. We'll use our Fibonacci retracements. And obviously this is a current chart, so we haven't yet moved into the extension areas. But here you can see we retraced back in a 3-wave cycle. Nice candle reaction at the 62% fib. Obviously this is a weekly chart, so you have to understand. Remember, we always talk about support and resistance zones. This is a zone. You don't want to use the exact number. But look at that hammer. Price came up to the 62%, and look at the hammer it developed. Now, obviously, it's a pretty big range here. It's a pretty big range, so if you're trading this weekly chart, you have to consider that. You have to adjust your trade size to account for the risk. Okay, but so far, price has declined back to test the support. Remember, this is the point where we take the risk either out of the trade or reduce the risk significantly. At this point, on a weekly chart, we will be locking in profits at this point. And let's just go ahead and measure the swing here just to see what type of a move we've had on this. So from the high to the low at this point, we've seen 1,663 pips. Right now, let's go to a smaller degree time frame. Here's a 15-minute chart. Now you can see here we have price, we have a divergence setup. Now this is one thing to consider. This is one thing in here. Remember, we talked about the small degree time frames being more susceptible to intraday volatility. So intraday data releases can have more of an effect on some of your intraday patterns. Okay? Patterns still work. It just means that if something unexpected comes into the market, it can break the pattern. If we really drill into this particular move, you can see we had a divergence initially, and price started to decline here. Started to decline. Okay, and then some type of intraday release caused this spike. And then price whipped back down here. Okay, so this is not a setup you would want to trade. Not a setup you want to trade, because this was caused by an intraday spike. Okay, and then after this you see that this subdivided into 3 waves. Okay, so this wasn't something at this point that we went to trade on a pullback. Now, let's drill down a little bit further here, and you can see right here, now we didn't get a very deep pullback, okay, because after this spike, we didn't get a very deep pullback. Now, actually, if we do this without measuring that spike, then you kind of get a better picture. Okay, here you can see how we had price move down. We retraced here right about to, let's call it just below the 50%, and then we continue down to that 1618 extension. Okay, so I just wanted to clear that up, just because the way we were looking at this, you could actually see that divergence. But anyway, I mean, you're going to have setups that fail, but you can see in this scenario the reason that wasn't something we want to trade. Now we have a nice qualified setup here with price moving higher, MACD cycling lower. Nice strong decline here. Traded through the low. Let's draw our Fibonacci retracements on here, and I'm just going to extend this over so we can see where this ended up. Three-wave setback to the 62% Fibonacci retracement. Price traded right down here to the 127, and then even continued on to the 1618. And continued down further, actually. But you can see the reaction at the 127. You can see the reaction at the 1618. All right, folks, we just looked at a weekly chart, and we looked at a 15-minute chart. And you can look at any chart in between. This will work on any time frame. That is what is so powerful about divergence and pattern trading, because it naturally adapts to the swings of the market. Okay, it's dynamic. It naturally adapts. So no matter what the volatility is in the market, the patterns adjust to that. And you'll see the same patterns over and over and over. It's human behavior.